Hello, everybody that is there, and thank you for attending the first collaboration between myself, Shehan, and Dr. Sean. Thanks for everybody for being here. We're hoping to make this a very informative, very educational AMA today, and we're hoping to take this collaboration and do more with it than just this AMA. We'd like to produce as much educational and informative content for everybody that's out there, so that everybody can, benefit from all of our education and information that we're putting out there. So we're doing this. I say a lot to say we're doing this for all of our followers and everybody that's in the crypto space. We're trying to not necessarily give back, but just give everybody kind of the best content that we can, and be kind of the facilitators to help everybody really grow in this kind of crypto accounting, crypto tax space, and help just our audience out there, and give you guys as much information as needed. So that's why we're getting together to start this series, and we hope that we can be as beneficial to you guys going forward. So we'll do some quick intros first, and then we'll go ahead and kick things off with the questions. So I'll start first. For those who don't know, I'm Joey Ryan. I'm the co-founder and CFO at Gilded. I am a CPA. I've worked in public accounting for 10 years at EY and RSM prior to co-founding Gilded. I worked on the audit side, so I've been there with all of you public accountants that are out there. I've been in the trenches with you guys, very familiar with auditing and accounting from that angle. And I went down the crypto kind of rabbit hole back in 2017, along with everybody else. But I really went down it, and a lot of you probably heard this story if you've listened to a few of my webinars. But I went down the crypto rabbit hole really from the accounting angle, really to understand how blockchain and digital currency and digital assets were going to revolutionize accounting. Because this was when, all the AICPA, Journal of Accountancy, all those guys, they were putting out newsletters back then about how blockchain's really going to transform accounting and flip accounting on its head. So I decided to be like, okay, let's learn about this new technology and how the impact that it's going to have on our profession. So went down the rabbit hole from that angle, and that's when I really kind of realized, wow, this really is revolutionary, and it's kind of the new innovation that really has the power to transform accounting going forward. So that's kind of when I got hooked in and got into this space, and that's how I got to where I am today. So happy to help with answers on the the accounting, auditing side of things, and hopefully can help you guys muddle through some of this blockchain and digital currency stuff. So that's my story. I'll let Shehan go in next.
Cool. So my name is Shehan, goes by the name The Crypto CPA on Twitter. You guys might have seen me. So I'm the head of tech strategy at CoinTracker. I told you guys I'm a CPA. Been focusing on crypto taxes for the past 3 to 4 years or so. Yeah, thanks for having me, Joey and the Gilded team.
All right, perfect. And I guess it's up to me now. So I'm Stein Smith, and I'm on Twitter, LinkedIn, Instagram. That's Stein Smith, by the way. So super easy to find. So in or on top of my current role as a educator, I came to the educational field after about 8.5 years working in accounting in industry, always as a sort of half IT, half accounting role. And then I guess I first heard of Bitcoin and blockchain. I'd say when I was doing my PhD research, I guess in 2014, 2015, I was like, cool, but I do not have any time right now. So I came back to it, I guess, in 2016, 2017, which I guess is when the bulk of us got into it, got interested in it and all the rest. And so really from about 2017 on, I've been hands-on in the blockchain crypto asset space in terms of training, research, publishing, speaking, books, courses, all the rest. And so I truly hope to add some of that new content, some of that objective lens as to try to analyze, right? How is blockchain and how is crypto already altering accounting, finance, markets, all the rest, and how it's going to do so going forward. And I'm also on the board of a crypto payment startup that I think Joey is familiar with. Gilded,
Yes,
by the
that's
way.
right.
Gilded.
Yep. Yeah, Dr. Sean's actually one of the official advisors for Gilded, and has been with us from the beginning. So, and we also have Farah. She's gonna help facilitate the questions. And so if you guys have questions that you want to ask throughout the recording, just throw them in the chat. Farah will make sure they get in the queue and get those asked. So with that said, let's go ahead and get this kicked off. So we've collected questions over the last week or two from everybody. So we have a running list that we're going to start with. And like I said, though, if you guys have questions, throw them in the chat. We'll make sure we get around to those too. So Farah, let's kick it off.
Hi, I'm Farah, and I work with Joey at Gilded. I'm going to be fielding the questions to Joey, Dr. Sean, and Shehan. So let's start with the questions that you guys submitted already, but if you guys have any questions that you come up during the event, feel free to use the Q&A feature. Okay, let's get started. So the first question is for Shehan from Ahmad, and Ahmad asks, if I'm looking to shift crypto gains into other passive assets like real estate during the next bull run, what's the best way to plan for it?
Shehan, you're on mute.
Yeah,
Yeah,
I'm on
you're
mute now. So I think your goal should be to minimize your capital gains taxes. So there are a couple of ways you can go about doing that. One being you should be selling your long-term crypto assets first. So that's going to kind of unlock you into the preferential tax rates versus your income tax rate. So that's one. And I mean, obviously, after you cash it out, then you can invest in like any type of passive activity, like buying a rental property or being a passive investor for business and stuff like that. So number one being just sell your long-term crypto first, and number two, when you sell them, you could sell the units that you paid the highest amount for. We call it high for accounting, highest in first out. So if you use some type of crypto tax software tools, it's just a matter of clicking the button. So when you do that, you're always selling the units that you paid the highest amount for, and that's going to give you the least amount of capital gains taxes. So I would do those two things.
And next, we have a question from David for Joey. Is there any unique guidance to serving clients in the blockchain space? All clients want a CPA who understands it, but are there common pain points you experience with clients in the space?
Yeah, so if we're talking about pain points that accountants or businesses are having, a few that we've identified first is everybody's kind of getting tangled up in spreadsheets, right? So that's one, utilizing spreadsheets and not trying to kind of automate your system and your process. So the second thing we're seeing is kind of what I like to call wallet hygiene. So making sure you kind of treat wallets similar to how you would with bank accounts. Maybe separate wallet addresses for different vendors or different revenue streams, however you kind of want to cycle it. So you want to make sure you have kind of proper wallet hygiene. You want to make sure that you're utilizing kind of automated tools that help track your crypto transactions that occur both in your regular kind of custody wallets as well as anything on exchanges. So you want to make sure you have the right tools that's tracking that. And then lastly, the third pain point is getting all of that data. If you're using crypto for payments, or if you're actually just investing in it and you have gain loss sales, but getting all of that data, excuse me, into your accounting system. So that's kind of the hardest mess, right? Is you have to use first you have to use something like CoinTracker to help understand what your cost basis is and your gain or loss is for the period on the crypto that you transacted with or bought and sold. And then you have to be able to record those transactions for crypto received, crypto paid, and any crypto bought and sold into your accounting system. So if you're using something like Xero or QuickBooks or even NetSuite, Intacct, some of the larger kind of enterprise systems, right now they don't support crypto. And there's nothing, none of those accounting systems truly do. I will pimp Gilded here. So that's what we're actually here to solve is to help automate that process of being able to get crypto transactions, whether again you're using crypto as part of everyday business for transacting in cryptocurrency and utilizing the benefits of transacting digital currency, or you're actually needing it for kind of buy, sell, investment purposes. Being able to record journal entries into your accounting system, we help really automate and smooth that process out. So I'd recommend using our system, but yeah, those are where the pain points that we're seeing and coming across is people just basically swimming in spreadsheets and spending a lot of time trying to reconcile transactions manually when we have the processes in place to automate a lot of that and save a lot of time.
Cool. So the next question is from Jordan for Dr. Sean. And he asks, would you say that Bitcoin is the digital version of gold? And if so, what is Ethereum the digital equivalent of?
So I would say that trying to equate Bitcoin to gold is an argument that's happened quite a bit. And now I would personally say that in terms of actually being a proxy for currency, Bitcoin is actually better to use compared to gold, right? And I could go on for like 8 hours about how Bitcoin and gold break down. I won't do that to all of you right now, but in terms of sort of from a overarching point of view, right? I would say that Bitcoin is probably the closest equivalent to gold out there, but there is no substitute for gold, right? Because gold is a metal, it's a commodity, whereas Bitcoin is more of a financial instrument. And so now I've probably aggravated both angles equally. So in terms of saying if Bitcoin is the digital version of gold, okay, fine, I can deal with that argument. Then if it was me, I would say if Bitcoin equals gold, Ethereum and Ether equal really the US dollar. Now, just hold on. Now, I would say that because of the flexibility, functionality, and the sort of universal appeal of Ethereum in terms of building out different applications, right? It can be DAOs, smart contracts, DeFi applications running on top of Ethereum, or Ethereum-like platforms that basically mirrors the sort of universal reserve role that the US dollar currently plays. So to put a finer point on it, if you are to argue that Bitcoin is the 21st century of gold, which I could argue back and forth, but okay, fine. Then I would say that Ethereum and Ether is the 21st century idea of a reserve currency or a reserve application backstop that mirrors what the US dollar does right now.
Cool. So the next question is from Sanjay for Shehan. And he asks, is there any tax benefit to starting a single member LLC and investing in crypto from the LLC? Would I need a separate account with exchanges, or should I continue to purchase through my personal account? Categorize that as I'm doing this as an LLC president.
Okay, it's a bunch of questions. So by the way, a lot of people like who don't know about taxes, they think that, setting up an LLC like kind of gives you this ability to, I don't know, like, save a bunch of taxes and etc. But that's not the case. LLC is not the solution to all your tax questions. Now, in your case, if you're a personal investor, and yeah, sure, you can, you set up an LLC, you can put your crypto into the LLC, and then you can trade inside the LLC. But that will not give you any type of tax benefit, but that will give you some legal protection because when you have an LLC, you have this thing called because it's a separate entity. So if something were to happen to you, you get sued because of, I don't know, for some reason, your personal assets are protected because you have an LLC. So there's a legal benefit of having an LLC, but when it comes to taxes, not really if you're a personal investor. And you also ask about how you go about doing that. You set up an LLC, you apply for EIN, and you got to apply on Coinbase or whatever the exchange as a business account. So instead of giving your social security number, you provide the EIN, and you can start doing your trading. But like I said again, there's no tax benefit, but you get some type of legal protection. But in some cases, having an LLC would be better. But in that case, like you had to be a trader. When I say trader, it's not like what you think it is in like in colloquial terms. Trader for tax purposes is somebody who's getting income from trading like 24/7. That's kind of their main source of income. So if you're somebody, you know, who have, I don't know, 5, 6 monitors on your desk and doing these tradings and straddles, you know, commodities and etc. like 24/7, and that's your main source of income, then you could be considered like a trader for tax purposes. If that's the case, setting up an LLC makes sense because then you get to write off like certain business related expenses like utilities, electricity, subscriptions, and stuff like that. But most people do not qualify as a trader for tax purposes. So setting up an LLC will not have any tax benefit. And as I mentioned earlier, it will have some type of legal protection.
Okay. The next question is for Joey from Lewis. And does blockchain within a given system eliminate the necessity for reviewing all transactions of that system?
Yeah, so I get this question quite a bit. So we say, you know, blockchain is a final source of truth, right? But the way to look at this is you have to verify that the data that's getting recorded and stamped onto the blockchain is accurate. So very similar to if you're relying on data coming out of a payroll, I'm going to use a payroll system, for example. So if you have data that you're inputting into a payroll system, so employees, paycheck amounts, et cetera, there has to be controls over that data to verify that that data is complete and accurate that's going into the system. And then you also, then the system kind of runs payroll, right? And then payroll spits out. And when it spits out, you also have to have controls kind of over the process between taking that payroll register and recording it into your accounting system and making sure that none of that data that got spit out kind of falls through or gets messed up or anything like that before it kind of gets input into your accounting system. So that's the way that I look at it is look at blockchain as that kind of black box or that payroll system per se. So transactions that go into the blockchain, you need to make sure that you kind of have, as a business, you have to have proper controls over the transactions that are going into the blockchain. Now you can verify that if the data going in is complete and accurate, that the blockchain is going to spit out complete and accurate data. Now, this is true for a public blockchain. Let me take a step back. This is true for a public blockchain. Private blockchain is kind of a different story because you can have different people that manipulate the data on a private blockchain. But on a public blockchain, Bitcoin blockchain, Ethereum blockchain, any data that's going in, if you verify that it's complete and accurate going into that blockchain, you can verify that once it gets kind of stamped and recorded on the blockchain, that's going to be accurate. And then if you're using that data that's then come out of the blockchain and recording into your accounting system, just to make sure you have the proper controls in place to make sure that that data gets properly recorded into your accounting system. So that's kind of my long-winded answer to that question.
Got it. The next question is from Alex for Dr. Sean. He says, you say that we're headed for mainstream adoption. When do you suppose that will happen? And what indications do you see that we're headed in the right direction?
Okay, so it is me, but it's also other folks out there too. Okay. And I would say that a few of the biggest trends or biggest highlights that I would see that are encouraging in terms of heading towards mainstream adoption are, one, that all of the oversight agencies, right, be it here at the SEC, the IRS, OCC, Congress, and internationally are actually being proactive, trying to pass laws, good or bad, but they are trying to pass laws to try to get a handle on blockchain crypto, how it's being used, who is actually using it, and then how is it going to overlap with the current control system. Even the bill that was introduced last week, the STABLE Act, Stable Act, even though that I don't personally think is a good idea, does indicate that this topic, blockchain crypto actually being used as a medium of doing transactions, is actually on the top burner. right, at regulators, policymakers across the board. One, and then two, right, having more conversations like this. I think that really since 2017, right, when the Bitcoin bubble burst, there has been a huge increase in the education and the understanding of actually what blockchain can be used for in terms of uh, AI CPA content, WSBA content, firms like Coin Tracker, Gilded, being out there in the marketplace trying to educate and inform both all of us working in accounting, audit, tax, but also the wider sort of non-expert user base, right? Because in order to get mainstream use and mass usage, all of us have to understand it fine. But it's the 85% of of everyone else who aren't experts, who aren't doing this every day, have to have access to education and information to actually be comfortable using it. And then the final point that I would add, that's probably the most obvious one, is that now there are major institutions from MasterCard, Visa, PayPal, Square, Fidelity, JP Morgan, all of these big incumbent institutions, BlackRock, Ray Dalio goes kind of back and forth on it. But all of these big time institutional players are now investing heavily into blockchain um, and crypto assets. And I do know that there are some Bitcoin sort of purists out there who aren't happy that all that is happening. But ultimately, in order to actually get blockchain and crypto into the mainstream and to actually get some of those benefits actualized, we as a blockchain crypto community are going to have to work with the incumbent rules and the players out there.
Okay, so the next question is for Shehan from Chai. Do I rely on software alone to calculate owed taxes? And if yes, which software for Uniswap, Coinbase, and Binance?
I think, if you can do your crypto taxes manually on a spreadsheet, obviously you're welcome to do that. But the thing is, if you're using multiple exchanges, like it gets like extremely burdensome for you to do it manually. So in that case, you had to rely on, some of these softwares that exist in the market. I mean, it could be Coin Tracker or there are a few others. But the problem is that if you ingest the same data into a bunch of these softwares going to give you different results because they're using different types of data aggregators and their algorithms work, a little bit differently from each other. But when it comes to the IRS, what they care about is, have you used a reasonable method to calculate your crypto taxes? So by you paying for subscription service fee for any of these software, that means, you have taken your reasonable measure, even though there could be, fluctuations between gains and losses between some of these softwares. It won't really matter because you have done your part as a taxpayer. And if you were to ask me what I would recommend, obviously I would say Coin Tracker. And it does support Coinbase, Binance, and specifically Uniswap, because Uniswap is pretty complicated because it's a different type of exchange that does not have order book. So there's multi-token transactions going on. There's a liquidity pools and stuff like that. So there's only few softwares that exist in the market that can handle Uniswap transactions successfully. And CoinTracker is one of the main ones. So I would give it a try.
Okay, so the next question is from James for Dr. Sean. I've been buying crypto for a few years now and have been reluctant to use my crypto transactionally because it keeps going up in value. Are stablecoins a good option for me? What are the pros and cons?
Sure. So if any of you know me at all, you would know that the whole asset-backed coin area is an area that I'm very amped about. And ultimately, and I know that I get pushback on this, I would argue personally that any asset-backed coin, be it a privately issued stablecoin or a CBDC, which is a central bank digital currency, is ultimately going to be a important bridge. Right now, I wouldn't say that it's the ultimate end form of how crypto evolves, but I would say that it's going to play an important role. in trying to get consumers to actually use crypto as a medium of doing business and actually pay for goods and services, right? Because in 2008, 2009, the idea of Bitcoin was that it was going to be used as a currency alternative, right? As a real alternative to the current fiat system, that has its upsides, but also has quite a few obstacles, right, in terms of how it's actually being used. And now in 2020, if you talk about Bitcoin in most conversations, it always is focused on the actual price per coin, which ultimately is not the point of cryptocurrency. Where the true point of cryptocurrency is to be used as currency. And so, in that light, I think any asset-backed coins, be it a privately issued stablecoin or a CBDC, are going to play a critically important role in actually getting people and firms and institutional players to accept, use, feel a higher level of comfort with blockchain and crypto as that underpinning payment layer now and going forward. Absolutely.
Okay, so next we have a question from Imani for Joey. What are the spaces one should inhabit to best position themselves to learn crypto accounting and meet potential employers?
Yeah, good question. So a couple of recommendations. AICPA has, if you're talking about just starting to learn some of the basics and stuff like that, AICPA has a really good digital asset toolkit, resource kit that's out there. I recommend everybody checking that out. Tax stuff, definitely check out Coin Tracker and Shehan's blog on Coin Tracker. He does a really good job of breaking down some crypto tax kind of 101 definitions, strategies, rules, that kind of stuff. That's great for a CPA to start getting their arms around on the tax side. The WSBA, again, I'm kind of tooting our own horns here, but at the same time, all three of us are very kind of deeply involved in this space. So a lot of the stuff that we're putting out is like cutting edge, kind of like, one step away from what some of these predominant AICPA organizations and regulatory people are putting out. So that's what I'm saying. Following us and some of the places that we are involved in is really a good start. So again, WSBA, where Dr. Sean is the accounting working group chair, is a great resource. You can follow. The accounting working group there has put out a few white papers in the last year or two that have been put out. Those are great resources to look into for white papers. And the AICPA, again, on that digital asset toolkit, has put out some updated accounting and auditing guidance out there as well. So recommend all three of those spots, as well as on the Gilded blog, we put out some good content as well for if you're looking for kind of accounting, payments, and bookkeeping associated with digital currencies. So I'd say start there. And then if you want to get involved, coming to things like this is a great way to start meeting people. Obviously, kind of being in the remote Zoom economy that we're in now, any sort of crypto meetups are a great place to meet people, and getting involved in kind of as many crypto initiatives as you can. You can Google the different kind of crypto accounting working groups or different groups that are part of different firms that are out there, and start following those people that head up those groups. And they put out some content or some good educational sources that's out there as well. And then there's always kind of, the WSBA holds some meetups every now and then. We were doing them before in person, and now they're Zoom. But there's definitely some places you can go where you can start kind of meeting people and getting involved in the space.
Cool. So the next question is from D for Shehan. How do we treat things like STK, Aave, or XSushi? When you stake your Aave or Sushi in these protocols, you get a different token back. This is different to staking where you don't get a token. When you withdraw, you get your Aave or Sushi back. The nature of this transaction isn't a trade, but some may say it is because you're receiving another token, even though you can withdraw your original.
Yeah, it's not a trade because you get to withdraw the original coin that you deposited into some type of liquidity pool or the contract. So it's not a trade, but every time that you get that second coin as a reward, you have to recognize ordinary income. And then the ordinary income that you need to report is the market value of the coin that every time that you receive it. So that's how I would approach that question. And obviously, when you take out your original collateral or deposit that you sent into the contract, that's not a taxable event because you just sent something and then you're getting it back. But as I mentioned a few seconds ago, like when you earn that new whatever the token, and if that token has a value, that's a taxable event.
Okay, so the next question we have is from Rem for Dr. Sean. What do you think of the Stable Act? In general, would you say that government regulation is a good or bad thing for crypto?
So
Is it stable? Is the act stable?
well, yeah, so that's a very
Right.
interesting question. And if you're actually looking for my more sort of long form take, I actually just put out a piece earlier today on Forbes analyzing the act. But in short, I would say one that I think regulation. I know it's always like a negative word, but it is, I think, important for the blockchain crypto space. One, to ensure that all of us understand sort of what the uh, ground rules are out there in terms of the laws, compliance, taxes, accounting, audits, all the rest, but to also give that support and that sort of backstop to that much larger, again, non-expert population, right? And so I think that while regulation is important, it's also important to not overstep, as we could potentially be doing with the proposed Stable Act, which in essence, based on my reading and my interpretation of the actual act itself, is basically trying to force every entity that either issues their own privately backed coin or any company that's offering services to any stablecoin issuer to basically fit under the full scope and compliance of rules that any commercial bank has to, right? And there are also components in there that actually prior to issuance you have to get approval from the Fed and the FDIC, and as the issuer itself, right, not actually holding those deposits at a partner bank, actually that the issuer itself has to get either FDIC coverage or hold those dollar deposits at the Fed. So really, it strikes me as a, and I'm being polite here because we're all friends. It strikes me as a attempt to fit the stablecoin issuing space into the current financial payment infrastructure without fully taking into account or appreciating why a privately issued coin is actually fundamentally different um, um, than the current commercial banking and current payment options out there. But ultimately, I would argue that yes, having some sort of clarity and transparency into the rules is going to be a upside benefit.
So the next question is for Joey. How have you seen the adoption of using crypto for payments grow over the past few years?
Yeah, good question. So two indicators I'm going to point to. One, stable coins. So they've grown from approximately, I think they were at like 2 billion last year to now they're sitting closely, I'm looking at the data right now, they're sitting right around 20 billion. So the fact that that has skyrocketed just in the last 9 to 12 months. And there's evidence out there. Jeremy Allaire from Circle has put out some recent data that's really suggesting that it's not just traders that are using these stable coins to kind of hedge their bets as they're trading and reduce some volatility risk, but they're seeing a lot of trends in the direction of small, medium-sized businesses starting to utilize stable coins for payment and receipt to be able to transact and again get the benefit of faster, cheaper, and more transparent payments on the blockchain. So the fact that the stablecoin kind of market has been booming, I think the Stable Act that Dr. Sean was just talking about is a good indicator of how far along we are in terms of how big this has become. You have the government now kind of thinking about putting these regulatory arms around it. We'll see if that gets passed. I know there were 10 or 20 or so crypto and blockchain acts last year that got introduced in Congress. I don't think any of them got passed. So we'll see what happens with this one. I have a feeling it's not going to get that far, but we'll see. But again, the fact that you have the government already trying to get their arms around it, I think you may see this go in the direction of CBDCs. We're seeing a ton of countries out there that are either in production or have started launching CBDCs. And again, that's a central CBDC is a centrally banked or centrally backed digital currency that's controlled by the government. It just runs on kind of blockchain technology. So you're not getting obviously the benefits of privacy and kind of true open source kind of crypto believers of what Bitcoin is, but you do get the benefit of transacting on the blockchain payment rails. So you eliminate the middleman, you're eliminating a lot of fees. So there is a lot of benefit to transacting and utilizing a stablecoin or a CBDC. So that's one. And then two, we just saw, I think it was late last week or early this week, where Circle announced they're partnering with Visa. They're on their fast track program. So Circle has 60 million merchants, I think worldwide, maybe more. And you could, Visa has 60 million merchants, maybe more. So you can see Visa's really taking the bull by the horns here as they see kind of Circle, which is the kind of parent company for the USDC stablecoin, which is, I believe, the second largest stablecoin behind Tether. So you'll see that, by partnering with the Circle guys, they really see kind of this digital currency stablecoin payment infrastructure, blockchain payment infrastructure as the future for payments going forward. So they're trying to take the bull by the horns and get ahead of the game to be able to enable businesses, merchants, and large institutions to start transacting, utilizing digital currency, and get the benefits of this. So I think those are two pretty big markers that are pointing in the right direction. And we'll see where this goes. And I think all of us in the space have seen this kind of coming in the last year or so. So none of this is really new to us. And I think there's going to be some really good progress going forward into 2021.
Next question, what are the tax implications of taking a profit of a sale in Bitcoin and USD versus a stablecoin? Another long-winded tax question for Shehan. If the intent is to reinvest the profit, will it be taxed? If I'm not taking the profits out of my Coinbase account but reinvest them, what are the tax implications if I convert to USD versus a stablecoin?
Yeah, so I think here's an easy way to remember the answer for this. Like you trigger a taxable event whenever you sell your cryptocurrency into, it could be to another cryptocurrency, or you're selling your cryptocurrency to a stable coin, or you're selling your cryptocurrency into USD. Cashing out or not, or the what type of cryptocurrency that you're converting your original cryptocurrency to, have no burden on your tax bill, because the tax event gets triggered when you dispose of what you had. So that's a short answer for that.
Okay. So the next question is for Joey. It's from Maletti. How can we pay freelancers with crypto? Are there tax implications?
Yeah, so best way to do that is through stablecoins. You can actually upload through Coinbase. You can upload US dollars for free. So you can connect your bank account to Coinbase and you can convert 10,000 US dollars into USDC for free. Coinbase does not charge a fee for that. And then the second you have USDC, which is your stablecoin, you can start sending that to any USDC address anywhere in the world. And your fee on that is pennies, if anything. So that's my opinion on kind of the easiest way to, I'd say, convert US dollars to a digital currency and start paying people. With stablecoins, as Shehan's pointed out, like yes, every single kind of digital currency transaction has a in the United States has is a taxable event, has a gain or loss associated with it. Stablecoins are meant to be pegged one to one to the U.S. dollar. Now they can fluctuate, 1.01 or even 0.99. But if you're, unless you're probably doing billions of trillions of dollars of transactions, I'm assuming that net difference between the up and down is going to be basically nothing. So if you want to talk about tax consequences, you're probably not going to have there. I'm 99% confident you're going to have zero to any tax consequence for transacting utilizing a stablecoin.
So the next question is from Anne-Marie to Dr. Sean. What do you think the regulatory climate will be like for crypto in 5 or 10 years? Is the government going to crack down and make it difficult?
So I would say that the outlook for the regulatory climate is going to depend on which country you are asking about. So assuming that we're asking about the US, I would assume that the regulatory climate is going to be more clear. Now, I would not say that it's going to be more open or trying to make it more more challenging, but I would say that by the time we hit 2025, 2030, we are going to have some clarity as to how blockchain and how crypto are going to be treated. Now, to add on to I think Joey's comment, the actual functionality of a stablecoin or a CBDC is ultimately, I think, going to sort of make those take a dominant role in terms of which cryptocurrencies are actually used on a everyday basis for the basis of transactions. And so then adding on to that, it is kind of going to make sense that the oversight and that the policymakers are going to focus on those, right? Trying to get those to work more seamlessly in the current payment system. And then ultimately, there will be some other buckets of crypto assets out there, be it Bitcoin, be it a commodity-backed coin, tokens, whatever, tokenized assets that I believe are going to be treated differently depending on how they're used, how they're issued, and then actually how they act in response to other financial instruments. So to ultimately put a short answer on that, I think that in 5 or in 10 years, the outlook in the market is going to be more transparent and more clear, but there are going to be different rules I would expect for different categories of crypto assets.
And the next question is from Dave to Shehan. How can I understand Coinbase tax reports?
Okay, Coinbase has 3 tax reports. So the most common one is the Form 1099-K. That's a tax form where they report your gross volume by month. You get this form if you have more than 200 transactions and 20,000 of gross volume in any given year. Again, it just only shows your gross proceeds, so it's almost all the time like overly overstated. So once you get a form, make sure you connect your Coinbase wallet to something like CoinTracker, and that way you can figure out your cost basis and that you pay taxes on the right amount, without paying taxes on that huge gross amount. So that's Form 1099-K. Number 2 is Form 1099 miscellaneous. And if you look at their Coinbase help page, you're going to get this form if you have Coinbase staking rewards. And if you went through that earn.com and got a bunch of cryptocurrencies as a reward for going through that education materials. And there was one other instances that you would get a 1099 miscellaneous. So in any given year, like if you earn more than $600 worth of rewards, that's going to get reported to you on a Form 1099 miscellaneous. So, and then I think Coinbase recently updated their tax center. So they're saying that they're not going to issue any Form 1099-B or 1099-K like going forward. They never issued Form 1099-B, but like for the 2020 year, like you will not get a 1099-K based on what they're saying. But again, they keep updating the tax, blog, so just keep an eye on it. Yeah, that's pretty much how we read the Coinbase reports.
Okay, so now we're going to move on to some Q&As submitted from users. So you guys could just take the questions as they come and decide who takes what. The first one, would you argue that ETH is money?
Dr. Sean, you're very passionate about that.
Yeah, so if you were to ask me, yes, absolutely, right? Because that and I think I saw a question come in asking about the Flare airdrop, right? And all of that sort of the true value in the actual run up of XRP and of ETH during the last year is in part due to the fact that Ethereum is actually the backbone for almost all of the new exciting applications out there, right? And I would argue that virtually the entire DeFi area is based off of Ethereum. And so it seems pretty obvious to me that if we're trying to pick out one cryptocurrency that has the most potential to be used, if we're trying to pick out one sort of old school cryptocurrency that has the potential to be thought of as money, I would argue yes, that Ether could definitely be thought of as money. Whether or not that ultimately happens is a whole separate issue.
Cool. So we have another question about mining companies. Before I had mining companies, it was pretty easy, money in and money out. However, today I move crypto around like crazy with how much ETH has changed. Are all of the transactions between my own wallets taxable events where basis has to be calculated?
Yeah,
No.
let me or Shehan, let me just
Yeah,
real
go ahead.
quick
Yeah.
give a quick response because Jake, I know this is from you, and then Shehan, definitely I want you to chime in after. Because and I want to make sure what I want to say is I want to make sure we're specific about are you talking about your multiple businesses? So if you have multiple businesses set up and you're moving so you have multiple entities set up and you're moving money or crypto between those entities, or are you talking about one business and you have many wallets where you're moving crypto in and out? And I just want you to, Shehan, I want you to frame your answer around those two specifics.
Yeah, I mean, if that's the case, it depends. Pretty much, the answer is it depends. Um, like for example, if you have like two wallets that you own like individually, and if you're transferring money from your own wallet to another wallet that you own located in a different exchange, that's not a taxable event, it's just a transfer. But if you're transferring money from one business to another, it could be anything, right? It could be, you're taking out profits and, sending it out to another business as an investment, or it could be, one business is loaning money to the other. So it comes down to how you account for it. It will not be taxable, but tracking the base is going to be super important. And I wouldn't like transfer like a lot of crypto in between businesses because that has so many other business tax implications. um, I would just try to keep things clean, pretty much.
Okay, so the next question we have, I have staked a decent amount of ETH to the core ETH network. Since I have sent my coins to the smart contract, am I still liable for them in terms of taxable are generated?
I'm sorry, I didn't get the first part of the question. Is this about the airdrop?
This is
You current.
about staking ETH. I've staked a decent amount of ETH to the core ETH network. And since I have sent my coins to the smart contract, am I still liable for them in terms of taxable gains and APR?
No, so when you send that 32 Ethereum to Ethereum 2.0 node, like that's not a taxable event. You're pretty much depositing your money. I mean your Ethereum. When you earn Ethereum 2 through the staking, like it's taxed as like income at the time of receiving. And hopefully they're saying like you can get back to you can get back to your Ethereum 1 after 2-3 years. Um, in that case, I don't think it will be taxable either because you just deposited your Ethereum 1 and later like you're getting back your deposit. But again, I actually wrote about this. it's easy to speculate how the tax is going to work, but it's really hard to give you definite answers because we don't know how this is going to play out in the real world. Because while your Ethereum ones are locked in the deposit contract, there are some exchanges that kind of give you like liquidity through like another token and stuff like that. So until we see how this plays out in the real world, it's really hard to say how exactly the tax is going to play out.
Okay, another question. Anything to worry about NFTs and how they're viewed from a tax perspective?
Oh, I'll take it, I guess. It just treated like a property. Um, any other cryptocurrency. So you have you have a selling price, you have how much you paid for it, and then there's a capital gain or loss event.
Another question. Thoughts on banks holding stablecoins and exchanges as a bank?
Well, I would say that actually, following the OCC update back in September, that all of that is actually going to happen. And actually, just earlier today, I saw that BitPay is in the process of trying to become a federally chartered bank under the OCC. So I would say that thoughts good in that it's already happening. You know, obviously that OCC clarification and the sort of go ahead was only published on September 21st, and I only know that date because I believe you were there too, Joey. The AICPA was having their blockchain symposium during that afternoon, and so yeah, I mean I think it's great and it's happening, and also just a anecdote here that the actual incoming CFO of BitPay is a former audit partner from a top 50 firm. So again, highlighting just how important getting a handle on crypto blockchain from a policymaking point of view and from a sort of rules oriented point of view is going to be going forward.
We have time for one more question and then we'll turn it back to you guys to just kind of give your closing thoughts. The last question is, what software is best for tracking crypto purchases?
I mean, I would say Coin Tracker because you can track your portfolio and it also does your taxes. So just 2 in 1. Yeah.
Yeah, agreed. If you're looking for tax purposes, CoinTracker is very good at what they do. And if you're looking for kind of business and accounting, obviously Gilded. So we'll pimp ourselves out here.
Okay, guys. So do you have any closing thoughts to send to our loyal attendees?
Yeah, I'll go first real quick. Yeah, thanks everybody for being here. Like I said, we plan on kind of making this a collaborative series going forward. So give us your thoughts. Either email us, you can email me, joey@gilded.finance, or email Dr. Sean or Shehan, and let us know your thoughts on the platform and content that you'd like to see going forward. We kicked it off with the AMA to kind of start the interactive between us and our audience. But let us know, like we want to be able to give what you guys want, obviously. So let us know either what platform, if you want to see podcasts, if you want to see more regulatory guidance articles, if you want Shehan to don the crypto tax king umbrella and give all of his crypto tax thoughts on everything, then let us know exactly what you're looking for, and we're happy to point you guys in the right direction and give you the best resources and educational materials we can. So, thanks for being here with us today. And yeah, I'll let Sean and Shehan kind of give their closing.
Yeah, and I would say that the only thing that I would add to that is that honestly, I mean, our whole purpose here is to help give all of you what you want, and to do so in the way and in the method that actually works best for you. If it's doing AMAs live, great. If it's doing podcasts recorded, and if it's doing interviews between us and some other folks, that's that's all certainly on the table. So yes, please do give us feedback, comments, questions, jokes. I'm always open for all of that. And I thank you all for turning out today.
Yeah, I mean, hopefully you guys found this session helpful. We're always available to answer any questions. I mean, especially me, like you can find me on Twitter. I answer questions like every minute. So yeah.
Cool. Well, thanks again, guys. And any more questions, don't hesitate to reach out. Appreciate you all being here. And yeah, thanks again. And we'll definitely keep this going forward.